Uh, Thank you, George, and thank you, Growth Drive, for giving me the opportunity to present here. So, for those of you who don't know me, I'm Mike DeSiato. I'm a CPA, but I'm also a certified exit planner, a certified exit planning advisor, and also a certified value growth advisor. So, I have a lot of C's after my name. I'm also a member of the Growth Drive community, and I spent over 40 years in public accounting, and I retired about 3 years ago. And to focus primarily on exit value planning and growth advisory work, I formed my own company called Business Transition Specialists, and that's what I do my work in. I do it through that company. However, with being a CPA and having a very strong tax background, I could tell you that I also advise a lot on tax planning issues that business owners face, particularly when when they are ready to exit, and particularly around their exit. So the goal today in this series is to help my fellow Growth Drive advisors understand that selling a closely held business is just as much a tax and deal structure exercise as it is a headline price exercise, right? So the same $10 million price can produce very different after tax outcomes depending on the type of entity we're dealing with, the type of deal structure we're looking at, either a stock sale or an asset sale, the deal terms, and also any pre sale tax planning that's done. And through this series, I hope to provide an understanding of those issues. And I encourage all of you to reach out to me with any questions you may have at any time. I am here to help. And George, as I think when you first started the Growth Drive community, one of our founding values and guiding principles is that we are net givers.
Yes.
And so I want to be true to that. So if you have any questions, don't feel free to contact me, and I'll be more than happy to help you. So let's get moving here. So this is a 5-part series, right? So the first, and the series is primarily designed to help you guys turn the headline price of a sale or a transition into a maximized de-risk after-tax proceed amount for your clients. That's the overarching objective here. So we're going to begin today in session number 1 with tax issues that arise before the letter of intent arises to help you understand how different deal structures, stock sales, asset sales, and entity types, C corporations, S corporation, affect what the owner ultimately keeps. And to make sure this is useful to everyone, uh, today we're going to begin with a very basic refresher on the basics. And this foundation is, in my view, very essential because the later sessions in the series will dive into more complex issues and real world applications. And now, if some of this is material, if it looks familiar to you, it sounds too basic, please bear with me because it's going to be the launch pad for much more advanced content that's going to follow. So in the next session, which is going to be held on June 10th, we're going to start digging deeper. We're going to go deep and we're going to examine entity structure as a long-term value driver. We're going to talk about Section 1202, the qualified small business stock exemption, and when it makes sense to use it. And also, we're going to talk about partnership LLCs. We're going to talk about how to handle something called the built-in gains tax. Also, what is an ESOP? What's the value of using an ESOP? All of which, and also finally, the net investment income tax, or the NIT tax as we call it. All of these have or can add or subtract a substantial amount of money upon an exit. In session 3, we're going to, which is again on June 17th, we're going to cover transactional tax traps, including purchase price allocation, recapture of depreciation, personal goodwill, sales tax, earnouts, installment sales, net operating losses, and covenants, all of which must be identified early so they don't quietly reduce net proceeds. And then session 4, which is June 24th, we're going to translate key deal terms such as target working capital, cash-free, debt-free, adjustments, true-ups, indemnities, and reps and warranties, and insurance around reps and warranties, and understand what their effect is on the net cash impact so you can negotiate beyond price. And then finally, on July 10th, we're going to talk about advanced pre-transaction tax and estate planning. including gifting, using profits interests, trust sales, and accounting method opportunities that must be in place before a buyer appears. And again, my goal here is to equip you, the advisor, the lead advisor, to coordinate tax, legal, and M&A specialists around one objective, and that is delivering the more tax efficient, strategically structured exit for your client. So that's to come. So let's start today with a general overview. Okay. Um, and I'll ask this question. It's a rhetorical question. How many of you wondered why so many businesses are set up as S corporations as opposed to C corporations? You probably also heard that buyers prefer to buy assets and not stock, while sellers prefer to sell stock and not assets. Why is that? Well, today we're going to answer those questions. So, what we'll do is we're going to review deal structuring and tax strategies for buying and selling a business at a very high level. We're going to examine both the buy side and the sell side. We'll calculate how the different deal and tax structures affect the taxes paid in a business sale from both the seller and the buyer's perspective. So, when you're talking about liquidity alternatives, right? As we all know, owners have a multitude of liquidity options. They can include shareholder buyout. It also could be an asset sale followed by liquidation. It could be an ESOP. It could be a transfer to active family members through gifting or a partial sale. It also could be a sale to a financial buyer or a management buyout. Each of these options provides a different path, right, to converting private ownership into liquidity. However, in my presentation, what we're going to be talking about primarily is focusing on a sale to a third party. So as a company is marketed for sale, the buyer may be a strategic buyer, a financial buyer, or a combination of both. And that distinction can shape the transaction. So let's talk first of all about the different forms of the transaction. So when selling a business, there are two primarily transaction structures. There's a stock sale and there's an asset sale, which is followed by a liquidation of the entity or the corporation. So I know this is very basic, but let's talk about something that's before we get into the deal structures. Let's do a little simple example for those who are not accountants in the crowd here. Let's talk about how gain and tax work when you sell a business. Okay, so very basic rules here, right? So when you sell a business, there's two key numbers to understand: what's your gain and what's your tax rate on that gain. So gain on the sale is basically, as it says here, as you can see, and I'm using NVIDIA stock as an example. It's your sales price minus the tax basis in the asset sold. And what is tax basis? Well, it depends on what you're selling. Okay. If you're selling assets, if you're a business and you're selling your assets, not your stock, the tax basis is the assets that you purchase that you have not already written off through depreciation or amortization. So it's your unrecovered costs of those assets, those tangible assets that you sold, and also the intangible assets that you sell, which generally have a zero tax basis. Okay. Now, if you're selling stock, all right, stock basis is basically goes to what you originally paid for the stock. And there's some basis adjustments that you'll make over time, particularly if you're an S corporation. And we'll get into how stock basis works in an S corporation. All right. So at a very basic level, you start with the sales price, which here's 100 grand. Basis, original cost, which you paid for more than a year ago, which is 20 grand. The gain is 80 grand. Okay. Now, the tax rate now on that $80,000 depends on your situation. Is it long term or short term? And in this case, it's long term. And in general, there's also on top of the 20% capital gains rate, there's also this thing called the net investment income tax, which is a sneaky little tax that creeps in. It's 3.8%. Okay. It's the Medicare tax. All right. That can creep in especially when you sell stock of a C corporation. You're going to most likely pay that as well. So the combined rate on this type of transaction is 23.8%. So the tax on this transaction is $19,040, and the after-tax cash is $80,000 $80,960. Okay. So that's a simple example. Very basic, but I feel like we have to discuss how this is calculated, and that's basically the basic foundation of it. All right, so let's get a little more detailed now. So I set up this thing called a seller's scoreboard. Okay, and now we're gonna do this. So at the upper right hand quadrant, I'm sorry, at the upper left hand quadrant, we're gonna look at we're gonna let me step back. Let me start over again. So here's the scoreboard, and this tool helps you walk through different transaction scenarios, specifically comparing stock sales versus asset sales. And along one axis, you'll see the distinction between a stock sale and an asset sale. And on the other axis, you'll see how each structure um, impacts a C corporation versus an S corporation. Okay. So we have these four quadrants. So let's start with the upper left-hand quadrant, which is a C corporation. And we have a stock sale. Let's say we're talking about a sale of C corporation stock. That simply means a buyer comes in and buys the shares of a C corporation directly from the owner. And then we're going to move over to the right side after we do that, and we're going to talk about the same concept as it applies to an S corporation, where someone comes in and buys the S corporation shareholder stock. Now, we're going to move down a little bit after that to the lower left-hand corner. And now we're going to look at what happens when you sell assets out of a C corporation. And what you're going to find there is that there's an additional step in calculating tax there. So after we have the asset sale of the C corporation, we're going to have a liquidation event. So the company will take those proceeds from the sale, the after-tax proceeds from the sale of the assets, and liquidate the company and distribute the cash to the owner, which, as we'll find out, creates a second layer of tax. And then we're going to move over to the right-hand side, and we're going to look at the same general process. We're going to see an S corporation sale of assets, followed by a liquidation of the S corporation, and we'll find out what the tax consequences are there. And we're going to find also that we're not going to have that second level of tax in an S corporation. So that's kind of a general outline. Now we're going to start digging into some of the mechanics here to show you what these things look like as we get into it. I guess this is a little bit of a sidebar here, but I want to clarify something before we go deeper here, and that is, a C corporation or an S corporation can be formed as corporations under the particular state law in which they're operating at, right? So you can go out, form a corporation in your particular locality, your state, and what happens when you're a corporation, as we know, is that the corporation is going to provide limited liability protection to the corporate owners, meaning that the owners are protected from the liabilities of the business. Now, the only difference between an S corp and C corporation in this context is that to be an S corporation, you have to make an affirmative election to be an S corporation. But for both state law corporations, they both provide this limited liability protection. Okay. However, I want to point this out because I've seen this a lot, and sometimes it makes sense. And I'm kind of throwing this out. It's perhaps a tax planning idea, right, for you guys. So instead of forming a state law corporation, I have seen, especially down here in Florida, and it may be applicable in your state, but owners form a state law LLC instead of a corporation, and then they can make under the tax law, they can make an election for that LLC to be taxed either as a C corporation or an S corporation for federal income tax purposes only. Okay, so it could be an LLC for state law purposes, but it could be taxed. You could elect to have it taxed as a C corp or S corporation for federal purposes. Now, why would someone do this? Right? Why would you do that? Why would you take this extra step and form an LLC and make either a C corp or S election? Well, I could tell you that in the state of Florida, and I think it applies to some other states, not only does the LLC also provide limited liability protection to the owners, similar to what a C corporation provides, But it also provides another layer of protection to the owners for any actions taken against them personally. So creditors of the owners, personal actions against the owners of the LLC, by providing them by providing that the exclusive remedy for any of those creditors against the owner is a charging order against the LLC's interest, and at least for multi-member LLCs here in Florida, meaning that a creditor of the owner cannot force or foreclose on the LLC interest and seize the LLC assets. They only get a charging order, meaning that they only get money if who run the company now, they will get it. If not, they don't get it. Okay. So next, now, in contrast, that any was state law corporation, that personal creditor could take control of the corporation, force it to liquidate, and seize upon the assets to satisfy a judgment. So I'm just saying, depending on the laws of the state you're in, it may make sense to form an LLC, make the tax election to be S or C corporation to get that extra layer of protection that an LLC affords, depending on the laws of your state. This charging order protection is very, very important. So, and one last point here too, and another little tax planning point, an idea is you may have an existing S corporation, right? That is a corporation under state law, and I can tell you that you can get into that LLC structure that's an S corporation. You can migrate to that in a tax-free manner, and it's I don't want to get too technical, but you can undergo an F reorganization and transform that S corporation into an LLC taxed as an S corporation to get that charging order protection. So, excuse me. So those are, I think, two things that you may want to think about, and if you haven't, well, maybe it's something to think about. Um, the other thing too I want to point out is a C corporation is treated as a separate taxable entity. So it pays its own income tax at the corporate level, right? And then when that income is distributed again, it's taxed again to the owner. So there's your class double tax trap of a C corporation. On the other hand, if you're an S corporation and you do that by filing an election, the corporation pays no tax. The tax gets paid at the shareholder level, and that's it. So um, that's the difference between the two. And as we're going to see, because of that difference, you're not going to see any double taxation when you're dealing with an S corporation, and that has implications when we talk about selling the company. And we'll get into that now. I just said a lot. So, um, does anybody? Well, we'll wait until the end, George. That's what you wanted to do. We'll wait until the end. All right. So let's start with the upper left-hand corner. Let's talk about the sale of C corporation stock. Very simple example. We're going to run through 4 of these, and we're going to compare and contrast what it looks like depending on the deal type, the deal structure, and the entity. So here we have a sale of a C corporation, right? Simple example: $5 million sales price, stock basis, the owner's stock basis, $1 million. Gain is $4 million. Here we're going to look at probably, I'm ignoring state income taxes. So this is only at the federal level. And assuming the stock was held for more than a year, the tax rate is going to be 20%. That's the long-term capital gain rate. And then we have the net investment income tax that's going to sneak in here and add another 3.8% onto it. So we're talking about a 23.8% tax rate for a tax bite of $952,000, leaving the seller of the stock with after-tax cash of $4,048,000. So we're going to take that result and we're going to put it in the upper left-hand quadrant here and say, okay, C corporation, sale of stock, this is what the seller gets after tax, $4,048,000. Okay, let's move over to the right side, the S corporation, sale of stock. Again, same example, $5 million sale, $1 million tax basis, $4 million of gain. Here's the difference. Long-term capital gain rate, 20%. Net investment income tax, probably not applicable. Why do I say that? It's probably not applicable because in the S corporation, in the context of an S corporation, if the shareholder is active in that trade or business, meaning in general, they spend more than 500 hours a year in the operations of the business. There is no net investment income tax. Okay. So that taxes on that $4 million gain are $800,000. Okay. So that's $152,000 less than the sale of the C corporation stock. So the after tax cash here is $4.2 million in this example. Now, let's stop and think about that. So if you have an S corporation and you have shareholders that are not active, all right, you may have some shareholders don't just they're investors. They put money in, they own stock. They're not active in the business. When that stock is sold, okay, they will not get this exemption from the net investment income tax. They will pay that additional 3.8%. Okay. So what I have done, and if you plan enough in advance, you can make those non-active people, you may be able to make them active in the year of sale. In other words, you may get them involved in some of the operations of the business. Remember, it's only 500 hours, okay? 500 hours, which is 10 hours a week, okay? If you can make them active now in the trader business, and of course, I would also pay them a W-2 wage for that, then, they, upon the sale of the company, upon the sale of the stock, they too would be exempt from this 3.8% NIT tax. And that could be substantial. Here it was $152,000. So just think about that. Just think about, planning ahead. If you have a non-active S corporation shareholder, there's going to be a sale of stock. If you want to avoid this NIT tax, make sure they're active in the operations of the trader business. You could do it. Sometimes you can't, but if you can, at least it's worth looking at and trying to do it. One other planning point here is this, and people miss this, and that is, what about spouses? What if you have one working spouse and one non-working spouse, and they own the corporation maybe equally, 50-50, or in some other percentage, right? There's a rule in this whole area that says that if one of the spouses is active, the other spouse is automatically treated as active. Okay? So be aware of that. Don't assume that just because one spouse isn't working, they're going to get hit with this NIT tax. They can avoid it simply because there's a rule that says participation of one spouse carries over to the other spouse. So don't assume that they're going to be subject to the non-working spouse is going to be subject to the NIT tax. Just keep your eye open for that, because that's something I see missed a lot. So going back to our little scoreboard, now we see that in the sale of stock by an S corporation shareholder, the after-tax amount is $4.2 million. Now let's compare it real quickly to the C corporation stock sale. The difference is $152,000. And that's primarily, it is due to the fact that there's no net investment income tax for active shareholders of an S corporation, but there is a net investment income tax on the sale of C corporation stock by active shareholders. So there's a difference there. Let's move on. Now it gets a little more complicated. Let's look at this form of transaction. Let's assume that we are going to have an asset sale followed by a corporate liquidation when we're talking about a C corporation. It's a two-step process. Okay. For a C corporation, we have two steps. First, we're going to calculate the gain on the sale of the assets owed by the C corporation, because it's a separate entity and it pays tax on its own. And then in step two, we're going to have to calculate the gain to the shareholders upon distribution of those after-tax proceeds from the sale of the assets. So let's go through that calculation. So here we have, again, the same $5 million sales price. Excuse me. And now the company is selling assets. So it has two tangible assets on its books: equipment with a tax basis of $500,000, inventory with a tax basis of $500,000, And then it has goodwill, which is really the intangibles. So goodwill is a catchphrase for all the intangibles. Usually intangible assets have a zero tax basis. So when they sell all these assets, equipment, inventory, intangibles for $5 million, the tax gain is $4 million. Okay, it's simply the 5 million less the half million and a half million gives you a $4 million corporate gain. Now, in a C corporation setting, there's only one tax rate, regardless of holding period, regardless of type of assets, it's 21%. This is, again, at the federal level. So the C corporation is going to pay $840,000 on the sale of those assets, and it's going to wind up with after-tax cash of $4.160 thousand dollars, right? $4.160 of cash. Now we got to go to step 2. That's the first step. Now the C corporation is going to take that money and liquidate. It's going to distribute it to the shareholders of the company. So here's the liquidation transaction. So $4.160 million go out to the shareholder. Shareholder stock basis, $1 million. Shareholders got a gain now of $3.16 million. Again, that gain is subject to, assuming they held the stock for over a year, long-term capital gain tax rate of 20%, plus C corporation, you're going to have to pay probably the 3.8% net investment income tax. So you're paying 23.8% on that liquidation gain. And now you're going to pay $752,080. And so the net cash after all this is $3,407,920. So it's the 4.16 million on top, this number, minus the 752 gives you 3.407920. Let's go back. So in this quadrant, when we have a C corp that sells its assets and liquidates, the owner winds up with $3,407,920. Okay, let's finish out this scoreboard. Let's look at what happens when an S corporation sells stock, sells assets, and then liquidates. Sorry. Again, this is also it's also a two-step process, right? But it's a little bit different here because with the S corporation, the gain on the sale of the assets is passed through to the shareholders who paid tax on that gain. The S corporation does not pay tax on that gain. And then what happens with that pass through of the gain, the basis in their stock gets increased by that gain. And you'll see how that avoids the double tax that you just saw on that C corporation liquidation. So let me walk you through this and I'll show you how it works. So again, going back to the basic example, $5 million of sales price. The assets have tax basis, equipment 500,000, inventory 500,000, intangibles 0. There's a $4 million gain on the sale of the assets. All the gain is attributable to the intangibles because I'm assuming that the purchase price is going to be allocated to equipment and inventory at their tax basis. So we have a $4 million gain. There's no tax paid at the S corporation level. There's 0. So the S corporation still has that $5 million of cash, right? That's step 1. Now here's when it gets a little tricky. Here's step 2. Okay, I got $5 million on S corp. I'm going to liquidate. I'm going to distribute that out. Here's what happens. First of all, the stock basis prior to the liquidation of the shareholder is $1 million. But that $4 million of gain on the sale of the assets gets passed through to the shareholder right here. And the shareholder is going to pay 20% on that gain. No net tax because I'm assuming the shareholders are active. So they pay $800,000 on that gain. What happens to that gain? How does it affect the transaction? That gain, that $4 million, gets added to their $1 million basis to increase it to $5 million. Okay? So that when they receive the $5 million of proceeds, they don't pay any additional tax on that. They only pay tax on the $4 million of gain, and they pay that at 20%. So there is a mechanism where the S corporation avoids the double tax situation because the gain that's taxed to the shareholders gets added to their stock basis. So there is no liquidation gain. So in this scenario, the shareholders wind up with $4.2 million of after-tax cash. Okay. And that's how the double tax, this mechanism of adjusting the stock basis for the gain passed through is a way of avoiding a double tax. So going back to our little seller scorecard, here we have it. Now the gain here, the after-tax cash from the sale of assets in an S corporation is $4.2 million. So I laid it all out. Here are the different scenarios: C corp, S corp, asset sale, stock sale. And if you start looking at this and you start seeing stuff, you're going to notice this, right? You're going to notice this. First of all, if you're a seller, you're going to prefer to sell stock and not assets, right? Up here. Because if I sell stock of a C corporation, it's a hell of a lot better than me selling the assets and liquidating, right? $448,000 versus $3,407,920. I'm better off selling stock here as a seller. In the S corporation setting, in this case, it's the same. But I can tell you that there are times when the selling of the assets could wind up with a higher tax rate because some of the assets may be taxed at non-capital gains rates. But at worst case scenario, it's the same. So as a seller, as a general proposition, sellers love to sell stock. And this is why you hear that. This is why. Take this example, you can see exactly why that's the case. But let's talk about the buyer now. This is the seller's perspective. Let's talk about the buyer. What happens to the buyer under a stock sale or an asset sale and how it affects them. So when a buyer acquires stock, there is no allocation of that stock price to any of the assets inside the entity that's acquired. And therefore, the seller doesn't get to recover their investment through tax deductions like depreciation or amortization until their stock is sold. Right? They don't get to write that off. They have to keep that price in their stock basis, and they'll recover it once they sell their shares. Also, for non-tax reasons, buyers don't like to buy stock. Another reason why they don't like it is because they also would inherit, if they buy the shares of a company, they inherit all the liabilities of the company, known or unknown. And of course, that risk can be mitigated at times by having the buyer put money in escrow to cover any unknown liabilities. And once the period is transpired where those liabilities are no longer enforceable, then the money will go back to the seller. But the primary tax reason is that the buyer doesn't get to write off any of the stock purchase price when they calculate their tax liability. However, when a buyer buys assets, they get to assign that purchase price to the assets acquired. And that becomes their new tax basis for those assets, which then are allowed to be written off through depreciation and amortization, and it generates future tax benefits. Those deductions generate benefits. So let's take a look at how that looks for a buyer. So on the left-hand side, we're looking at a buyer that buys stock, right? They pay $5 million for the stock. Now, the only write-off that buyer is going to get is there's $500,000 of inventory and $500,000 of equipment. Okay. Well, that's going to be able to be written off by the company that they bought. They're going to get tax deductions inside the company for that. So at a 29.6% tax rate, I'm using that as an example here, they get to recover $296,000 of their $5 million purchase price, bringing their after-tax acquisition costs from $5 million down to $4.7 million. Okay, so they get some write-off there, but not a lot. Okay. On the other hand, if they bought the assets instead of the stock, not only do you get to write off the $500,000 of inventory and equipment, that intangible asset or goodwill, that $4 million, that gets to be amortized on a straight line basis over 15 years. They get to write that off. So the tax benefit there is about almost $1.5 million, $1.48 million. So the after-tax cost of an asset acquisition is $3.5 million versus $4.2 million. So this is why when you look at this, the difference between the after-tax cost of a stock acquisition versus an asset acquisition, the after-tax cost of an asset acquisition, an asset acquisition is much better by almost $1.2 million in this case. It's much more tax efficient to buy assets because you get to recover your costs through amortization, depreciation, and the cost is less. Now, if you want to kind of relate that cost to an ROI. So if you're buying a company that's, throwing off $1 million of income a year, if your after-tax cost of acquisition is $4.7 million, that equates to a 21%, 21.25% ROI. But if your after-tax cost of the acquisition is $3.5 million, your ROI in the purchase is now up to almost 28, 29%. So this is why the buyers generally like to buy assets. It increases their ROI, and they get the tax benefits associated with it. So let's talk about some key takeaways. I know I kind of ran through that pretty quickly, but I just wanted you to see this. It's kind of foundational. We're going to build on this later on, but people often wonder why, and I said at the beginning, you see a lot of S corps and not C corps? Why do you hear buyers like to buy assets, sellers like to sell stock? These examples kind of show you why. So from a seller's perspective, S corporation status is generally preferable to C corporation status because of the reasons we just showed you, right? But we're going to talk a little bit more on that in the next webinar, where we're going to discuss this small business stock exemption for C corporation stock, the $15 million exemption. You've probably read about it. It's all over the place these days. In some cases, being a C corporation may be better than an S corporation when you sell. And we're going to talk about that, but not always. The other thing that I think we kind of see as a key takeaway is sellers will always want to sell stock. I mean, they're generally predisposed to doing that. It's cleaner for them. The taxes are less than if they sold assets. And so they generally prefer to do that. Now, one of the things, and of course, buyers prefer to sell assets. And we went through that example. And that's the reason why. If you do the math, they come out with higher rates of return when they do asset deals. So one of the issues that we're going to talk about in the future is, and I've seen this happen a lot, is that, okay, the buyer wants to buy assets, the seller wants to sell stock, but we really can't have a stock sale. It's not commercially feasible. Sometimes the company has so many non-transferable licenses, patents, copyrights, you really can't buy them and strip them out. It gets very unwieldy and almost impractical. You can't do it. But the question becomes, is there a way for the buyer to buy the stock, but yet get to treat that transaction as if it were an asset purchase? And the short answer is yes. And we'll talk about that in the next webinar. Okay, I'll show you how that can be done. But so there is a way for accomplishing that. So not all is lost. You can do a stock sale that's treated as an asset sale, and we'll discuss that in subsequent webinars. So again, the next one we're going to be talking about is the entity selection and its effect on the tax consequences of a business transition. And I think that's, I think it was June 3rd or 4th, if I remember correctly. And then we're going to talk a little bit about the transactional tax issues that come up, deal terms that come up, and how that affects net cash. And then some of the pre-income tax and estate planning that can go on. But today my focus was just foundational, just to show you the math that goes around these different forms of transactions: stock sale, asset sale, C corp, S corp. Uh, you got to get an understanding of that before we can start digging into some of the various alternatives that are available. So I'll stop talking, and if you guys have any questions, I'm here to answer.
Thanks, Mike. That was great. Great. How are you?
Mike, I do have a question
Thanks, Mike.
on the asset sale within the C corp and then the liquidation. You assumed that it was a capital gain, 100% of it. Is that really true? Because
You mean the C corporation's asset sale followed by a liquidation?
yeah, the liquidation price, isn't it? Is it? And it's been a long time. So, aren't there
That's all right.
earnings and profits that create a dividend treatment for a portion of that?
No, not upon when you have a. Yeah, I hear what you're saying, Rick. Right? No, I mean the liquidation is treated as a sale or exchange of stock. It's not a dividend. Now
So
you are correct. I mean, there could be accumulated profits in there, but they come out upon liquidation as capital gain.
they do,
Yeah, if it's part of the liquidation.
as long as
So
it's 100% liquidation.
right, if it's
Okay.
100%, if you're redeeming 100% of the shares, then the entire transaction is treated as a sale or exchange of that stock, which is treated as a capital transaction.
Okay.
Even though you're distributing out earnings and profits that you've accumulated, all right, in the past, that's still treated as a capital transaction because it's in exchange for 100% of the shares.
Okay. Thank you.
Cool. Thanks, Mark.
Thank you, Bob.
Rick, any questions?
No, I just finished eating a pretty heavy lunch and
Now you're going to sleep. I think I put you to sleep after this.
I live this stuff and it can still glaze my eyes over.
So, Rick, do you work in public accounting at all, or are you CPA?
Um, no, I have not been in public accounting for probably 40 some years.
God bless. Good for you.
I I went strictly into corporate, left corporate, and then got involved with small business taxation. Um,
Okay.
I have been involved in a couple of asset sales out of S corporations, though. And they handled just like you said they would. So,
Yeah. Again, people always wonder why you see so many entities structured as S corps. Now, this is probably one of the main reasons why, as opposed to a C corp, because you avoid that double tax when you liquidate on the sale after you sell your assets.
right.
Uh, and a lot of people, that's the main reason why they go into S corps. Now, there's other ongoing tax savings that you could get as well, but I'm not talking about those. But this is the primary reason that you could tell there's quite a large difference, right? If I go back to the seller's scorecard here, you could see that if I sold assets in an C corporation, I'd wind up with $3.4 million of cash. If I sold assets in an S corporation and liquidated, I'll wind up with $4.2 million of cash. So that's a lot of money. It's almost $1
Yeah.
million difference.
Yeah.
So that's why you see S corps. People like the S corp. They understand that they'll avoid that double tax upon liquidation of the C corp, and that's why they migrate to it. Now, there's other reasons for it too. I could tell you that, but I mean, there's all types of considerations, but the primary thing driving it is this after tax cash upon the sale of assets upon when you sell the company.
Yeah, the majority of S corps I've worked with, um, very few of them have gotten to this $5 million price range for sale. Most of them started off small, and the reason they went with S corp was to save some of those self-employment taxes.
Exactly right.
Um,
It's exactly right. That's a big driver. of S corp status is that they're trying to save on the self-employment tax. And so by using an S corporation and paying themselves a reasonable but small salary, they avoid much of the FICA tax if they don't pay themselves the FICA base, and also the 3.8% Medicare tax. That drives a lot of this too. But
Right. Yeah.
that's a savings. But when you think about the long term and you're talking about exiting, there's also
Right.
this benefit. There's also this benefit as well.
Now, what about the S corps that do become successful and a buyout firm may want to buy them?
Mhm.
And they want the S corp to get converted to a C corp, um, so they can be issued different levels of stock and stuff. Is that where your F corp or your F reorganization comes into play?
Well, I haven't seen that happen. I see it different. I see a different version of that.
Uh-huh.
So you have a big buyer coming in and they say, look, S corporation owner, uh, we want to buy your assets, okay? And the S corporation owner says, fine, I'll sell you my assets. Uh, well, let me step back. Um, they want to buy assets, but they can't do an asset sale for commercial reasons. In other words, the entity, there's too many things commercial inside the entity that cannot be undone. There's licenses, there's agreements that are non assignable. That they have to buy the interest in the entity because they can't strip out these assets and it gets to be cumbersome. So they want to buy. They want to do an asset acquisition, but and how do they do it? So here's how it works, and we'll get into it later on. But if you want to talk about it now, I will. So what happens is the S corp undergoes this this F reorganization process, where the owner of the S corp forms a new S corp, drops the stock of the old S corp in the new S corp, and then the old S corp converts tax free into a single member LLC. All right, that's an F reorgan. That's tax free. I
Okay.
shortened it, but that's what happens. The existing S corp becomes a single member LLC under the new S corp. All right, but the single member LLC is the original company. And then what happens is the new S corp sells the LLC interest to the buyer, and that buyer buying a single member LLC interest, that for tax purposes is treated as an asset sale.
Okay.
So that's how you can do it, and that's what I've seen done. Now, there's another way they could do it, which is they could buy the S corporation and make something called the 338H10 election, which is it would treat the stock purchase as an asset purchase. They could do it that way, but a lot of buyers today are really concerned about that because in order to have that happen, in other words, in order to make that 338H10 election work, you have to make sure that the S corporation you're making is a good S corporation. I say good. So you'd be surprised how many people have violated S
Right.
corporation rules, and they probably don't qualify any longer. And for a buyer to do due diligence, if they didn't inadvertently cause them to lose as status, and I find it fair for LLC interest that you're going to create, and then the issue goes away. So I see a lot of PE firms do this all the time because they don't want to have to deal with did I buy a bad S corp, and now my 338H10 election to treat the stock sale as an asset sale is not valid. So they kind of deal with that by having the existing S corp do an F reorg, which is nothing more than a paper transaction. You don't have to move assets. You don't do anything. I've seen it done in one day. So they make them do that, and then they buy the LLC interest, so they don't have to worry about, am I buying a good S corp for this 338H title action?
Thank you.
Thanks. Mark.
You're welcome.
And this is where getting good tax advice is worth every penny.
Yeah, we'll see that, because as we get deeper and deeper in here, it's not what the sales price is; it's what you put in your pocket at the end of the day, right?
100%.
So, I seen I seen the top line number, get reduced by, God knows, 40-50%, and not just by taxes. And we're going to talk about, other adjustments like, required net working capital, reps and warranties, all kinds of escrows. You got to be very careful, because a lot of this money can be siphoned off in various ways, and we'll talk about that.
Awesome. Excellent.
All right.
Thank you very much, Mike.
All right. My pleasure.
Great
Good
intro.
job.
Really appreciate it. Looking for the next one.
All right.
That's next
Any-
Wednesday.
yeah,
at 2 p.m.
Yeah. Any questions, please reach out. I'm available. I'm always willing to help. Anything I can do to help you figure something out, just reach out, and you know where I am. I think hold on. You going to share the slides, George?
Yes, we'll show the slides. We'll
So
share-
here, if you want, you can see it here. My contact information's there.
Perfect.
and
so-
be reached throughout the community as well.
And through the community, through Circle, I'm also in there. So,
Perfect.
any questions? Feel free.
Awesome, Mike. Thank you very much.
Thanks, Mike.
Thank you.
Have a good day. Bye now.